earnings kickoff. We have more inflation data. How do you size it all up for us?
So at the end of the day, the market is still discounting the future incorrectly, in my opinion. We are looking at consensus in the back half of this year, forecasting for mid-single-digit growth in earnings for third quarter, 10% earnings growth in the fourth quarter. And it is still unclear to me how we get from here to there, with right now consensus being at about -7% earnings growth, or earnings decline, I should say, for the first quarter. And so somewhere along the way, the market is either going to have to discount appropriately what the future looks like, or the future looks very different than what many of us think. Right now, the market is discounting interest rate cuts probably in the middle to the back end of the year. That's something that I don't see. And the market is discounting that we will not see a slowdown, recession, whatever you want to call it. Also something that I don't see in the cards for this year.
I mean, we are in an earnings recession. It's undeniable, obviously, but like every recession, you come out of it after you go into it. And maybe earnings are in the process of troughing, no? Although it sounds like you think they're going to get much, much worse from here.
Well, look, it's funny that you say that. You say we are in a recession. How long has the masses rejected that notion, Scott? And
no, we're in an earnings recession. We're in an earnings recession for certain. If you look at the numbers of last quarter plus the expectations of this quarter plus those for next, we're going to have 3 quarters in a row of negative earnings growth. That's what I'm saying is undeniable. The numbers are the numbers.
Right. It is undeniable when it is not deniable anymore, but it has largely been denied up until that very point. I guess what I'm saying is that think about December 31st. The projection for this quarter was flat. And here we are a short 3 months later, and it's -7%. That's a pretty big change, Scott. And I think that consensus is off by similar magnitudes for virtually every quarter this year. What that means is that we're going to have continued aggressive downward revisions. It means our multiples are wrong.
And you still think the Fed is going to be more aggressive than people want to believe?
I'm not sure it matters anymore, to be honest with you, Scott. I think it's the first time we can say that. We spent 2 years Fed watching the market's ups and downs predicated on everything we thought the Fed was going to do. I think we're actually starting to transition out of that. I'm not sure it matters anymore if they're going to be another 25 bips in May or not, because what we do know is that the credit crunch is real, and that's going to do some of the Fed's lifting for it. The Fed just hasn't figured out how much it's going to do. So they will certainly pause soon. I think the difference of opinion is that some are forecasting rate cuts this year, and I think that is wishful thinking.
Is a pause not good enough, though, to at least signal that we're done? We're done hiking, and the market may have to wait longer than it wants to for actual cuts, but at least it would know that the hiking cycle is over.
Yeah, and I think that that's a good thing, except I think the market's attention will now be turning to what used to drive it, which is the macro and the multiples and the earnings growth. And I think that when people start to focus on that again, they're going to find precious little earnings growth this year. And they're going to find that the market isn't trading at 18 times forward. It's actually trading at 22 times forward right now.